Right. Should be live. And it's 10 after 4, so let's do it. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here is pretty much the same. And so let's talk about this market. This market is crazy town. This market's crazy town. All right, so the S&P right now is flat. Actually, we just pulled back a little bit from our close. We closed green in the S&P today. Blow my mind. NASDAQ is down 0.6%. That makes sense to me. IWM is down 0.3% and closed above 230. I know Pat wanted a little bit of a better close than that. So I provided this list of stocks in the morning meeting today because I've been doing a lot of thinking. A lot of thinking last night, a lot of thinking this morning. I'll repost that list right here into the VTF. This is a non-exhaustive list. And it's basically stocks that I would categorize as destroyed. Like, these stocks aren't just in bear markets. These stocks are like in full-on depressions. I mean, a lot of these stocks are in bear markets for the month. I was actually running some numbers and some of this stuff earlier. I made a little video about it before, so that should come out hopefully the next day or two. But like even just from the highs of the month with some of these stocks, PayPal's down 19%, Twitter's down 15%, Fubo is down 40%, DraftKings is down 29%, Zillow's down 44%, Peloton's down 54%. Chewy's down 20%, ATVI 22%, SoFi 24%, Robinhood 28%. These are from the highs this month. Some of these names are from the highs like 2 weeks ago. Teladoc 32%. When look at these charts, right? Look at the Teladoc chart. Look at Fubo down 40% on the month. DKNG down 29% on the month. ATVI down 22% on the month. Roku down 29% on the month. What else do I got on the list here? Lemonade down 33% on the month. STNE from its month highs is down 49%. I think that might be the winner. No, Chegg is CHGG. And this is just a list of random stocks that I'm aware of that I knew were down a lot. Chegg is down 60% from its highs of the month. Tilray is down 20% from its highs of the month. Alibaba is down 20% from its highs of the month. And then when you look at these that are, yeah, Horiel, that's definitely what I'm trying to get into right now. And then when you look at these off their year highs, they're all 40%, 50%. Some of these are in the 70%. Chegg here. No, STNE looks like it's my leader. No, Tilray is my leader on the year, down 83% on the year. Now, most of those highs are from February in most of those stocks. I mean, we can look at what Tilray did in February. It's a perfect example of a stock that was in a bubble. And I was saying it at that time. You know, everybody on the team, I'm sure, remembers December last year, January, February, really especially January, February. I was like, this just isn't right. This isn't normal. You know, these stocks are absolutely in bubbles. And if you look at these charts are so interesting because many of them have went like completely, you know, parabolic, and then, you know, just totally gave back kind of the entire move if you really scroll out far enough, which is okay, really. You know, it's actually a sign of a healthy market. It's a sign of a stock picker's market as well. But it's interesting to see just how far down so many names are on the month alone. We got the S&P on a closing basis is like 0.5% off highs. The NASDAQ, you know, like 2% or whatever off highs. IWM a little bit more. IWM is maybe down like 5% off highs. So, part of this is the market is doing what it should do. And I've been talking about this for a long time, and it's interesting because to some degree I feel like they throw the baby out with the bathwater here, because there's some names on the list of like 40 stocks or whatever that I posted earlier. There's some names on this list that I actually like the company. I want to be long the stock, like in theory. And there's some other names on here that I've been saying from the beginning that these companies are just trash. Space, Lyft, Palantir, some others. Canadian marijuana companies, I've never been big fans of those. Roku. Some of these names I just think are absolute trash. And the big thing, to go back to Pat's note this morning, is that the market is really wrecking growth names that are not profitable right now. And why are they doing that? Well, they're doing it because the potential rise in interest rates. It's what's supposed to happen to a lot of these stocks. You're an unprofitable company that isn't going to be able to be profitable for 5-10 years, and you're just relying on that free money to come in, and the market starts to think that free money can disappear. Well, then how are these companies going to survive? What's interesting is that the market still, though, is not punishing some of those names that you would think could have the same problem, like an LCID, or honestly even a Rivian. I know Rivian is well off that $180 high, pulled back from 180 to 110 or so yesterday in like 4 days. But it's still, given companies like this that are just going to lose billions and billions of dollars, a very hefty valuation. So I think that a lot of this is normal and healthy. Bad companies should go down. And it wasn't healthy, and I was saying this at the time, when bad companies were going up 200, 300, 400% at the end of last year into the beginning of this year. So it's definitely a really interesting market. But what I've been looking for, so the question is, at what point is this priced in? Is I'm trying to figure that out. At what point is the interest rate stuff priced in? Or at what point can we at least see an oversold bounce in some of these stocks? And the fact of the matter is, we might be nowhere near fully pricing in to the downside an increase in interest rates in these speculative names that lose money. Maybe some of these are worth even 50% less than where they're currently trading. They easily could be, and then a couple of the good ones will survive. And that, in some regards, is actually similar to the tech bubble, where you had all of those .com companies and the vast majority of them went bust. But at a certain point, what did Amazon trade down to price-wise at lows post .com bubble bursting, right? Wasn't it like a $3 stock or something like that? But yet the real ones were able to kind of come together over time and obviously become some of the fantastic companies that we know and love today. So I think that some of these names on this list could potentially be those and could potentially really come together. And others on these will probably go bankrupt at a certain point, especially if the interest rate situation starts increasing. But with that said, coming into today, yesterday was a really bearish candle for this market, right? For the SPYs, for the Qs, for the IWM. But it's just one day. And all it did, like I was saying in the morning meeting today, was bring the SPYs right back down to equilibrium, right? Where they kind of should be. The Qs right back down to equilibrium. Qs yesterday morning were extended to the upside. Today they touched the 21 EMA. How is that abnormal? It's not. But yesterday's candle was definitely, really damaging to the big picture of the market. And I was a little bit worried. I kind of laid out 3 potentials for today. And this sounds very obvious, but up, down, or sideways, right? That's what I'm thinking about. What's the probability of us going up? What's the probability of us going sideways? What's the probability of us going down? And the thought process that I came up with was that the lowest probability was actually going to be an up day today. even though we are still broadly in a bull market, yesterday was just a really damaging day with us closing on lows and us selling off the way that we did. You would expect some follow through corrective price action, whether that's through time or through price. And we kind of discussed basically pullbacks to the 21 EMA for these daily charts of the SPYs and Qs as being very normal. But what would happen to the IWM, which is already pretty weak here, and this 230 is a really big level, should that actually happen? And what happens to a lot of these really kind of destroyed stocks? That was the other kind of big question. So I thought that the lowest probability was going to be just a big up move again today. I thought that in second place would actually be a down move, even though we could see follow through from yesterday. And I actually thought that the highest probability situation for today was actually going to be more chop, where the market struggles to really break down further despite yesterday's weakness, but definitely can't give a solid bounce either. And to some degree, we got that. There was definitely some weakness earlier today. I actually called this high perfectly into the VTF. We snapped back. I was like, all right, guys, we could see a snapback to 469 here in the SPYs. And the high here was 469.09. And then I was calling out that if we broke this opening low, it could be really damaging because that could lead to further downside follow-through in the market. I know for the SPYs, I talked about kind of the area between the 21 EMA and this last pivot low. So, look for the market to try to find some support between like 463.50 and 462 for the SPYs, should we kind of have more constant sideways price action. The low of the day is 464.45, so we didn't quite get down to that low, but it definitely looked scary here when this opening low broke here was the signal to kind of get out of the way on some stuff, because we could genuinely further break down. But now looking at it here at the end of the day, like I said, the S&P somehow closed green today, which is just crazy. I know XLE and XLF was strong, which is also what we talked about in the morning meeting. Look for that relative strength in the XLE and the XLF. We got that. I don't necessarily think that those trades are easy because they're being relatively strong right back into resistance levels. So we can look at those. But at the end of the day here, the SPYs just turned into choppiness. Now, where I was wrong was I thought that if we could get the market to kind of go sideways here a little bit more and kind of digest even with volatility, which by the day end, we did get that. Where I was wrong is that I did think that if the market could genuinely or generally be choppy today and generally sideways, though it was like sideways with a downward tilt, which I guess does make sense, I thought that maybe we could see a little bit of relative strength. And I'm really just talking about mean reversion. A little bit of relative strength in the IWM, a little bit of relative weakness in the Qs. I guess at the end of the day here, the IWM is down 0.25% and the Qs are down 0.6%, so we did see that. But I thought that could also facilitate an actual bounce back from oversold levels on that list of stocks that I was kind of talking about earlier. Again, you look at just like a Fubo, which is one that I've been trying to catch a bounce trade in and have obviously been really struggling to do that, having trades kind of continuously fail on me and holding a core position on this to watch it and just kind of bleeding out in that smaller core position, feeler or whatever you want to call it. But this is an example of a stock that has just been extended and has stayed extended and has just gotten at times more extended and sometimes a little bit less extended, but has kind of been basically extended the downside ever since its earnings report, which was 10 days ago. I mean, look at this chart, and there's a whole lot of these where just every single day is just been red here. It's brutal. Like I said, this is one of the stocks on the list. I think it's down 40% from its highs in the month. It's down 30%. Even if you take away the earnings gap, it's still down. This is a 30% down move. So my thought process, which wasn't perfectly correct, though we'll see if we can actually get a little bit of a bounce in these tomorrow, because a lot of them did close with inside days like PayPal or doji days. The thought process I had was that maybe we could see a little mean reversion if the market could chop, where some of these stocks actually catch an oversold bounce while the Qs show some relative weakness, and we're able to get some mean reversion, because it just seems so extreme to me, and I understand the why. And that's what I said in the beginning of the meeting. I understand the why on why these things are down. You're an unprofitable company, and the threat of rising interest rates is looming. Your days could really be numbered. But when you're looking at stocks that are down 20 to 40% on the month, how much of that is kind of priced in at this point? I would think a decent amount of it's priced in, where if the market can go sideways, they can catch an oversold bounce. Again, not looking for too much, looking for a bounce back to the space between the 8 and 21 EMA on the daily. DKNG, a bounce back to $40 to $42. Again, considering how much is DKNG down on the month. Let me go to my little list here. Down 29%, and the month isn't even over yet. So that idea turned out to generally be wrong. Unfortunately, it just kind of is what it is, and a lot of these stocks that were weak tended to be really weak, but we did see a little bit of a rally into the close in some of them, though not really this DKNG that I have up in front of me right now. But if you look at like Chewy, this Chewy was able to give a little bit of a bounce back kind of off of those lows. If you look at like Sumo, Sumo was able to actually close flat to green on the day after bleeding out to new all-time lows again. Let's take a look at some others. What about like a Roku? I don't really trade now. Roku still looks terrible. Roku still looks awful. Penn, I don't look at as much. Not so great. The SoFi couldn't catch a bid at all. The secondary announcement still obviously really hurting that one. So anyway, bottom line is that we didn't really get that oversold bounce, and these stocks are oversold and are still oversold, and some of them are down 20%. And again, I do think that it's justified that these stocks are at these prices. Not sitting here saying like, oh my God, like this is completely overselling these names. I would say that the speed in which they're selling them off is kind of the crazy part, not the fact that they're selling them off. But we know bear markets, down markets move faster on the downside than they do on the upside. So, but are we in a bear market? Again, it depends on what you're looking at. If you're looking at a lot of those names, yes, but then you type up the SPYs, type up the Qs, honestly, even you type up the IWM, which is corrected a little bit more, we're not in a bear market. So the mean reversion I'm looking for did not happen in most of those names, but the XLE caught a great bid and was able to close back above 57. 57 was the key level that we were discussing for the XLE. The XLF was definitely tricky, but still managed to close above the $40 level that we spoke about. So there does seem to be a little bit of a flight to value, and the speculative names are not value names, right? The speculative names are getting hit hardest and most. And the IWM is interesting because up until very recently, really these last couple of weeks, it seems like when the IWM catches a bid, the stocks that are the most value stocks catch a bid, and the stocks that are the most speculative stocks, which a lot of those are in the list I provided, would catch a bid as well. And now we're not necessarily seeing that in the same way. So it's a potential little change in the market that we need to continue to monitor. As far as trades go today, mostly things are disappointing, I think. The eBay short that we called out in the morning meeting was one of my ideas for the day. Short through like 74 on the downgrade. That one worked out pretty well. WeWork was disappointing. Hedgeye came out with their data. The presentation, I actually got to look at that a little bit. And it didn't really move the stock. It moved the stock actually 2 days ago, and Hedgeye announced that they were going to do it. Bed Bath & Beyond was super disappointing today. I really thought that today was going to be the day on this 24, and I didn't really think it on some of these other days. And today I really thought that today was going to be the day where this thing would break out above 24 and potentially give a further short squeeze. And the price action on that was so bad. I remember thinking that this third inside bar shouldn't have happened. That it should have continued already. Great opening candle. Look at the volume. Breaking through the $24 level in the first 5 minutes after closing at it yesterday, getting above yesterday's high. This first candle had everything I wanted to see in this Bed Bath & Beyond, followed by an inside bar, rest bar here. It's fine. I was so excited about this potential trade. I was telling people in the VTF that it's probably a good idea to cheat versus this low. And then when the second inside bar came in and it wasn't given follow through, and the market continued its bounce back to this 469, and Bed Bath & Beyond, which is now breaking out and should really be squeezing higher, wasn't grinding along at a very minimum, doing what the market was doing. That was a concern. And of course, recognizing that concern, it led to the failure of the potential trade when this thing got back below $24. And the stock went circuit broken today, which means it was down over 10% at one point on the day. It closed down 8%. So just crazy amounts of volatility, the percentage in which some of these stocks are moving. And obviously Bed Bath & Beyond is, a very different type of stock than, looking at, I don't know, SPCE, right? Looking at space. So same thing, really interesting market that we'll continue to monitor. I do think that this market has been pretty difficult the last several days here, and it's not showing itself in the SPYs and the Qs, because you got others, and you got this Apple, where Apple should go down today. And I know it actually closed well, but when Apple was going down today, it should go down today. Like this opening price action when it was acting weaker, it's extended and gave a shooting star. This thing should be price and time correcting into the 158 area. And it barely was even able to do that. Low of the day was 159.06. And then we saw boatloads of bullish option flow coming into the market, into the close on Apple. So that keeps happening. And again, that's a flight to safety. That's a recognition of the fact that certain types of companies like Apple might actually be able to perform well in higher interest rate environments, higher inflationary environments, but these other types of names just probably can't or won't, or a select few of them will really be able to survive and kind of come together in the long run. So that's pretty much it. It's where we're at. It's a really interesting market dynamic, and we'll continue to see how this plays out, and we'll try to pick our spots. But looking for that, oversold bounce trade here again today, just not working. So that's why you've got to manage your risk. Manage your risk. It's key to the business. So that's all I got. Happy to take a look at what you guys got as far as questions go. Excuse me. Sorry. So Oriel's question, which I looked at briefly before I started the meeting, is the first one on here. How do you stay positive about the overall market when this many stocks are getting whacked? Thank you in advance. I've seen this kind of story before, though maybe not to this degree. I'm trying to remember what year it was. Let's take a look at the market and see if I can figure it out. It might have been 2015. Where was that year where the market really double bottomed? Yeah, it was 2015 into the beginning of 2016. I remember this really well. It was kind of like double bottom that was down here. This was not quite a bear market, if my memory serves me correctly. And so the way that they measure a bear market is when the market's down 20% on a closing basis. And this was like one of these things where, was it a bear market? Was not a bear market? If you measured from the high and low, if I remember correctly, it was more than 20%, so you would define that as a bear market. If you measured it from closing high and closing low back in 2015, it was a market that I think went down like 19.5%, which is technically not a bear market. And again, this is just going straight off memory right now. But I remember the average stock in the market, right? Remember that the market's market cap weighted. The average stock in the market was down like 38% or something like that in that pullback at the end of 2015, early 2016. So without a doubt, it was like a major bear market for the average stock that you looked at, whereas with the SPYs, it obviously wasn't. I guess in some ways what we're seeing now is even more dramatic, right? Because the market is down, what did I say, 0.5% on a closing basis off of its highs. We are nowhere near a bear market. But, like you're saying, there are so many stocks getting whacked. I got a list here, and this was basically a list that more or less came off the top of my head. This was not me searching for weak stocks. This was just me knowing a lot these off the top of my head speculative names, and like without even trying, I was able to like write down 30 to 40 stocks. And like I said, every single one of them just on the month alone is pretty much in bear market territory. So you can have a kind of bear market for stocks, similar to what we had in that late 2015 and early 2016 sell-off, while still having the market itself hold up, and that's because of market cap weightings. And even if you look at an equal weight, it's probably not nearly as good as this, but not nearly as bad as what some of those stocks are doing. So we kind of have to take it for what it is, and that's the scary part that I keep kind of talking about here so much, which is, on the one hand, if the market right now is down 8%, and I was looking at this list of stocks that's down 20 to 40% and is as extended as it is, I would be being like in the VTF room here. I would be like 10,000%, guys, we got to be looking for the spot to be able to get this oversold bounce. Like, these things are so beaten up. Market's down 8%. These stocks are down 20, 30, 40%. I'd be like pounding the table on us trying to really grab these longs. And yeah, am I looking for the oversold bounce? I am, but not like that. I remember doing that in May. May, back here, was last time that a lot of these same speculative names were super beaten up. Like, look at Palantir's low here. Was exactly in May. Fubo's low here was at $15 in May, and that's these things had it was multiple months, not a couple weeks, but it was over the course of multiple months. Just had a pullback where these things got so hated and were down so much into those levels that I remember specifically into the gap down on this day on May 11th in the virtual trading floor, just like yelling at everybody that we got to get involved in a lot of these names for this bounce, and that bounce exceeded my expectations. So again, I guess it's a lot of it is perspective, but outside of the fact that we're extended, in a lot of ways, with the exception of maybe the fact that we just gapped down so big this day, the short-term extension is significantly more here than it was there, but on a percentage basis, obviously it was more there, but it was spread out over the course of a 4-month sell-off, not a 2-week sell-off. So, and that's the scary part to me still, Ori, like I'm saying, is what happens to these stocks if the market actually does sell off? And that's what I was also saying in the morning meeting about correlations. Like, I basically said in the morning meeting today, like, guys, I'm looking for oversold bounce in these stocks, but not if the market itself sells off. So I thought that once we broke the opening low in the SPYs, once we broke here, that was your signal to not be trying to buy any of those beaten down stocks for an oversold bounce until the actual low came in, which we also called out in the VTF really well. Again, we called out this low in the IWM to the candle basically perfectly. Extension on the 5-minute, volume picking up. They're overshooting the 230. I guess some credit where credit's due. We called the high of the day to the 5-minute bar in the Qs yesterday, and we called the low of the day to the 5-minute bar in the IWM, and therefore a lot of other stocks literally to the 5-minute bar today. But yeah, it's hard to stay super positive right now. That's why I've been trying to get through this mentally myself, because it's different. And some of these losing names, to answer Russ's question, because it's something I've also thought about, are potentially definitely being exacerbated by tax harvesting. This is Brent brought this up yesterday, and I kind of thought maybe it was a little bit early, but maybe it's not. To be liquidating some of your stocks that are broken, like a lot of those names I just went through, if you've got Apple in your investments or whatever, and you're trying to avoid taxes, and you're taking those for a write-off. Next year from Chinggis, you've mentioned that the SPY is not so clean on technicals. Why do you use the SPY to analyze the market? Well, the SPX isn't clean either. Neither of them trade clean on technicals. The SPY is fine for analyzing the market. It does exactly what the S&P does. The only difference is dividends. So you're looking at a 5-minute chart of the SPX, you're looking at a 5-minute chart of the SPYs in real time, they're going to look the exact same. Next year from Jerry, Ever consider making a video of a live trade from setup to execution and cash flow around a core position? I think it would help newer traders. I can't. I can't. Compliance would not allow that. I might be able to try to do it on a demo account, but I don't trade on a demo account. And the execution on demo accounts is not perfect either. So compliance will not allow me to show certain things. It won't allow me to show my exact execution, my exact tier size on positions that I'm in. I'm not allowed to say exactly what price I'm bid or offered at. I can kind of give like some hints, you know. And traders who know my trading well enough, like Felipe always knows. Felipe is always able to know exactly where my offer is. So it's like if you want to know where my offer is, I can neither confirm nor deny. But if you ask Felipe if we're trading a stock together where I'm offered, he's probably gonna know because he knows me that well. So I'd love to do that, Jerry. I'd be down to do that. It's a little bit difficult from a compliance hurdle perspective. Jwm is down on earnings. Jeez, this is another one. A lot of those retailers got destroyed on earnings this morning, and I didn't look into it too deep, but I thought that the Best Buy numbers were pretty good. I thought the Dick's numbers were pretty good. I'm seeing that these actually did snap back pretty well during the day. A&F maybe not as much. You had Nordstrom here destroyed after hours. Is Best Buy moving on that at all? Where did Best Buy close? Yeah, it's down 20 cents. Good, Jerry. Awesome. From Shane here, can we review September? Can we review September? Yeah, this is where the market corrected, right? But I feel like the market's down more in November than it was in September. So let me reread the question. Can we review the month of September? During the month, for the most part, the Qs corrected 30 points. SPY was down 5 to 6%. TLT went down. Yeah, it did, particularly into the end of the month, right? From 150 to 141-ish. Okay, that continued into October. So rates were up. Do you see any similarities? Yeah, so interest rates are going up. Interest rates are supposed to be going up, right? Do you see any similarities this week? Any takeaways from past performance to think about what we are doing with this market? I feel like this market is treating this recent increase in interest rates different than what happened in the end of September. And they're doing it by, they didn't really punish. I mean, they punished stocks in general in September, but it seems to be significantly worse right now. It seems like the market, which is a forward-looking mechanism, is almost like pricing in like some of these companies might end up being worthless if they can't continue to properly raise money at cheaper prices. And at the same time as that, which I don't think that we saw in September, and that's why the Q sold off as much as they did, is a flight to safety. And Apple is viewed as safety, right? Apple should hold up just fine in an inflationary environment. Apple should hold up just fine. Their business should be just fine. Maybe their multiple compounds a little bit. Multiple compresses a little bit. I mean, not compounds. Maybe their multiple compresses a little bit as interest rates pick up. But the market's not pricing that in because it's being viewed as a safety trade. And I think that people are just piling their money into Apple right now. Amazon maybe not as much, kind of had a breakout failure. Microsoft definitely. Google for sure. And that's why, September the market came down as much as it did. And right now, the SPYs and the Qs are not coming down. But we're seeing the damage. It's like we're seeing the damage of the potential rise in interest rates significantly worse in certain stocks than we saw in September, I think. But we're at the same time not seeing a deterioration in the market because people still need to put their money somewhere, and they're putting it in things that they think are safer in that type of environment, which is, in some ways, these FANG names, which is pretty crazy. So that's kind of what I think the differences are right now. That's that. Damien saying, what exactly is meant by mean reversion? So the one of the best ways to think about mean reversion. So there was a time in my career where I used to do some stat arb trading off of a gray box. and stat arb trading is all about mean reversion. So basically what you do is you take two similar companies and you measure their typical correlation into the market. Let's say Coke and Pepsi is an example. The Coke and Pepsi actually would not be, they're actually too correlated, so you wouldn't want to use them. But let's keep it simple. Let's talk about Coke and Pepsi, for example. So Coke and Pepsi, very similar companies, right? They should move together. They do move together. So if the market starts, for whatever reason, buying up Coke and selling off Pepsi, then they're going to deviate from their typical correlation. And then a stat arb trader, as a mean reversion trade, would short the outperformer, short Coke, and purchase the underperformer, purchase Pepsi, and basically look for mean reversion, which is basically the meaning that they come back to their average correlation of one another. So to a degree, all markets have a correlation to one another, right? Like, and that's why, you know, it's rare. It's not rare to see like the Qs go up and the IWM be weaker, or the IWM be stronger and the Qs be weaker than one another, or even for periods of time. But it is unusual to see like the NASDAQ be green every day and the IWM be red every day. And I know that that's not exactly what's happening here, though it's been obviously a much deeper sell-off for the IWM than it has been for the NASDAQ. There should be some correlation, though, between the IWM and the QQQ because they're both market indices. And to one degree or another, those market indices should trade together. They have a correlation. And when the Qs are going up every day and the IWM is not, and I look for mean reversion, or even in more extreme examples, I look at some of these stocks that are on the list that are significantly destroyed, significantly beaten down, and I say I'm looking for mean reversion. Basically, it just means I'm looking for a snapback to that equilibrium area. You know, again, DK and GM move from 40 to 42. It's at 35. It's a decent snapback. You know, you could get $5 to $7 of upside in DKNG, but it's got to give a signal, and the degree of the sell-off. These numbers are kind of mind-blowing, and I understand why, but the mean reversion I'm kind of talking about is like, how can you come up with this many stocks? How can I come up with 30 to 40 stocks almost without even trying? Just off the top of my head, names I know are super beaten up, that are down 20, 30, 40% on the month when the market itself made all-time highs yesterday. So mean reversion basically would be, in this case, those stocks going sideways and the market coming down, those stocks getting a bid as the leaders come down, so something like that, to come back a little bit. It doesn't have to be too dramatic, but just a pivot low, bounce back. I mean, just to see on the daily chart here, one candle after the next be red, be red, be red. DKNG actually sneaked in one green one yesterday. A lot of these don't even have a single green one. It's a big kind of deviation, I think, from typical. So that's what that means. Next here from Sebastian. Since Bed Bath & Beyond closed above 24, I tried to buy 24.60. We all did. I think your price was not fantastic, though. Yeah, I think a lot of us had a little bit better pricing on that, but same trade. And it looked like, to me, I really thought this Bed Bath & Beyond was going to do it today. I really did, and it totally failed. The market has something to do with that for sure. The fact that its resistance has something to do with that for sure. We could, like I mentioned this earlier when I went over the trade, we could see the relative weakness coming in on the 940 candle. This thing should have exploded again on the 940 candle. Like, first candle was a fantastic breakout explosion on great volume. Second candle, inside bar, volume comes down a little bit. This third candle should have broken both the highs of the last two, and it should have done it on significantly higher volume than the second candle. And that was your signal there that it was going to trade, that it was going to fail. I'm still a believer in buy the ticket, take the ride. So I think you just keep your stop loss out there and study the market, and it is what it is, because otherwise you can talk yourself out of just any trade that exists. But the trade failed, and the market certainly didn't help. But this thing started showing relative weakness, and that resistance has been really strong for this thing. What do I think of STLD tomorrow? These names held up great. Energy names held up great today. They look fantastic. XLE back above 57 looks fantastic to me. I think, U.S. Steel, I don't like that candle for U.S. Steel, actually. CLF, I think, looks pretty good. STLD looks great here. It's got this thing above 68 inside day today, so I like it. From Robert, really appreciate your comment and market reviews. These days it's really difficult to read the market. I agree, but recognize relative strength in the XLF and XLE like today is saving my day. I still need to be able to at least make some small money. Thanks for your great job. Thank you, Robert. I appreciate the compliment. Yeah, we definitely were able to recognize that relative strength in the XLE and XLF early. So we mentioned that as kind of a focus in the morning meeting today. And they were still a little bit tricky because they were trading into resistance today as the market was acting a little bit weak. But, relative strength and relative weakness is a big part of the game today, a big part of the game, period. So that was good. Next from Sam. If we go sideways, would that be a good time to liquidate and sell options? So I am not an options trader, but generally in a market that is going sideways, selling covered calls for cash flow or something like that could be a strategy that you might want to look into, especially if you got some swing longs on or what have you. So yeah, so something to think about. Oriole asking about Sam Adams. Oh yeah, so I didn't even think to put this one on the list. This one's destroyed, albeit probably also with good reason. They made a real big mistake business-wise with their seltzer business model that they were doing, and that led to a huge multiple expansion because the market at first liked it, and they saw that their seltzer was not selling, and now it's destroyed all the way back down to where it started from. Yeah, so this is just another name that's super beaten up here. This is a good day for it though. Green on the day, a little volume pickup. It's right in the moving averages. It's hard to love it, but maybe above like this 490 to 500, you could start getting a better turnaround in this thing. Japan plans to release 4.2 million barrels of oil reserves. Adam saying, I have over 20 years of trading and investing experience. This kid, Derrick, that's me, is super talented in reading day-to-day sentiment and technical market health. I'm in awe of you daily. I appreciate the compliment there, Adam. I really do. Very noted, very appreciated. Next here from Jerry. Thoughts on Bank of America today using the opening low as an out? Yeah. So definitely not a momentum name, but this is what we wanted to look to for relative strength. I think it might have gotten a price target increase. I talked about $47, and this along with a couple other ones. So XPEV was another big idea of the day today. And the opening entry on both XPEV and Bank of America to not get shaken out of these was actually really difficult. I did not like that this Bank of America with its relative strength broke its first bar low. And I know it did that still above the ADMA. So if you followed my typical rule of, don't have your stop above the ADMA, then you're probably fine with this thing. And did this candle break that candle low? No, it held to the penny. So if you did the thing that I like to do, which again is never really having a stop loss above the ADMA on that time frame, then you were able to hold this BAC. If you were trying this BAC versus that first quick low in the first 5 minutes of the day when this thing was breaking 47, I totally get it. You got shaken out of the trade. It does, like you're saying here, it tends to not be a momentum name, and it does, and we do have the ADMA situation as well that I'm always constantly talking about. So that is the issue with the trade there. So definitely didn't make this one super easy, but if you're able to stick with those rules and utilize this as your stop loss once the ADMA caught up to it, then you were able to capture the relative strength in the stock. Aaron asking me about a few names here that we could take a look at, so let's take a look. First is Adobe. Yeah, so Adobe overall has been a strong name, but along with the Qs, got hit pretty hard and gave a tail back today. So I think Adobe looks fine as long as it's continuing to hold above like the 640 area. If this thing gives you like a close below 640, and I don't think you want anything to do with it. I don't know if you're in or where you got in from or what your time frame is on the trade, but broadly, it's an okay candle in a bullish stock. And as long as above 640, it's all right. But you also really want to see this thing get back above 670 soon. NVIDIA, everything is fine in bull market land of NVIDIA and AMD, really, right? They just kind of came back down to their equilibrium and gave little pivot lows here. This NVIDIA basically gave a pivot low into the ADMA and into the gap fill. I think some of you guys are even looking at that as a trade. So NVIDIA looks okay. But along with the NASDAQ, the candle from yesterday is pretty damning here. So big picture, as long as it's above like 288 or arguably even this low of 271, I think it's okay. Big picture. Small picture, today was a good day for the stock. It held where it was supposed to, but you're still fighting a little bit of a battle because of yesterday's more bearish type candle, which granted was in extended territory. Caterpillar, I haven't looked at this thing too much because I know it's just been ranging out for a while. I think the stock is sloppy, so I don't think there's anything to do here. It'll start looking a lot better if it can get back above 215. And CLF, I think is, I think I just mentioned this one when I was looking at STLD for, I think it was Sebastian that asked it. I think CLF looks good. You got some relative strength here. It closed green on the day today. You want this thing to get above $23. So I like it. I like the company. The chart's been a little bit sloppy. From a trading perspective, it's been a little bit sloppy, but broadly it looks okay. So that's my thoughts on those 4 stocks. Dylan here giving us some statistics on percentage in which certain companies are down that we could take a look at as a team as well. Just kind of reiterating the information that I had said earlier. All right, gang. So that is it for today. I appreciate you guys. Hope you guys are managing this market really well, because it's definitely been tricky. I think for the last week or so has been in some ways a unique environment to any other environment I've ever seen. So we're working on continuing to navigate that, and tomorrow morning we'll see how we gap, and we'll figure it out again. So have a great night, everybody.